Okay, and welcome to the Maui 18 information. Now, what is this class for? This little 1 hour class, and I'm going to try to keep it real short because I don't want to ruin anyone's weekend. I just have been getting so many email questions about Maui, about the details of it, um, about the content details. I wrote a book. Actually, the first two books I wrote ever were like huge hits for some reason. I don't know why. I wrote the first BWB book anyone ever wrote about them, and after that, I wrote a collars book, and they just took off. And so people were like, "Well, this is spiked collars. I already own the collars book you bought before. How's it different? I already own liquid. How's water different than liquid?" So this is really designed to answer everybody's questions, so that when they come to Maui, whether they're doing it online or actually coming to the island itself, they're well aware of what's in store for them. Because I do not believe in writing a second book about the same topic unless it's 100% improved. Um, so this is what everything is for today. This discussion. When what we're going to be covering today is just every little detail that people want. Obviously, if I don't cover everything, feel free to write us and we'll be happy to answer. Um, this will probably be, I don't know, 15th time to Maui, but the second time for Stratagem. And some of the crew that I brought last year will be there again this year, like the film crew and our office manager. So if you guys got any questions, the people working for me are familiar with what's going to be happening. If not, I'll just answer it myself. And what we're going to be covering is the who, when, where, what's, hows, and whys of this class. There's going to be broken down into three subjects, and one is trade augmentation. And I've never taught that before, other than overviews in a pot class, but I've never given the criteria. And the step by step criteria is what most people need and find helpful or mandatory to get this stuff done and to understand it completely. I think the reason why my first two books I wrote were such a success is because I took it in a step by step approach and people just embraced it. And so that sort of became our trademark, and it became our brand. And it's only because I always try to teach as if I'm teaching my son, my youngest son, or my grandson right now. And Albert Einstein once said, you don't really know a topic well unless you can teach it to a 5-year-old. And that's how I write. I don't want to write material to show off of how smart I am or how much I know. I want it so it's practical and you guys can embrace it, understand it, and implement it. And trade augmentation is probably going to be the most difficult of the classes. It's the most creative and pushing the pencil and bending things around. But it's still kind of vague to some people. So let's start off with that. Trade augmentation is really just layering different strategies on top of each other. If you have a brand new blank slate account, trade augmentation doesn't work. As you open up an account and start trading and start rolling your positions from month to month, sort of like what we do in pot, you start building an inventory. And that inventory of how these positions act collectively has its own risk profile or characteristics. Now, maybe you have on 5 trades and you're happy with that. All of a sudden, you see something happen like we saw on Friday where Tesla just fell out of bed on Thursday after earnings. And then Friday, it looked like it stabilized and you wanted to get long, which is what we did. And now you want to know how this fits in with the portfolio as a whole. By creatively designing a position that takes your existing portfolio into account, you can minimize the risk of any trade. And that's the whole beauty of this trade augmentation. If I want to get long Tesla by itself via stock or a call spread or what have you, I'm going to be looking for a way to hedge it in case I'm wrong. Now, because of systematic risk, where if the market as a whole is selling off, it tends to drag every stock down, my overall portfolio will probably go down too. And what will happen to this new trade I'm looking to place? How will that move in relationship to all the other trades? And by carefully designing and putting strikes in a certain area, we can have the group of 5 original trades help out the 6th trade. And we've had tremendous success in this with pot classes. But real quickly, what is trade augmentation? It's just a process of knowing your existing positions. So when you add a new position, you have a little bit of a hedge already built into it. If not, you're going to have to pay for a put or put spread or put butterfly or put condor or some other thing to hedge the downside risk. And that's money going out. And if the market doesn't go down, if you were right in your assumption that Tesla's going to bounce after these bad earnings and the subsequent drop, and you're trying to bottom fish for the bounce up, the put hedges you're buying are going to be a waste of money. Whatever you're paying for that is going to be a waste of money. And why buy it if it's not needed? And in the pot class, I used Tetris as an example. The risk graphs are a visual indication of people to people of where the risk is, how it looks throughout the price chain. There's usually little holes in there, and what is the cheapest way to fill up those holes? And we're almost playing Tetris with different strategies where a condor may be the long rectile and a ratio spread is a put or a call ratio looks like those L's. Risk reversals had that big block characteristic. A call vertical spread, as you see in the bottom left corner, looks like the graph of a call vertical spread. We're trying to visually clean up our risk because visually seeing things is a lot easier and faster and more tangible to most people than deltas. So let's say, for example, just for trade augmentation, real quick down and dirty example, and I'm going to go through these things fast because I have a lot of slides here to get through in an hour. Let's say we put on a long delta risk reversal in the SPX. This is our standard typical risk reversal that we've been doing in the SPX for months now. In order to keep long deltas in this bull market, we're selling a put spread to help offset the cost of a call spread. As you see above, you see the 2600, 2610 call spread. We did this, I think, Wednesday or Thursday, this actual trade. And then, because it was so expensive, we decided to reduce some of that cost by selling a put spread to take in money. And we sold a 25, 35, 30 put spread. That cost us $2.20. Now, anytime we do this, we have a lot of downside risk. As you can see, this particular trade has $7,200 of downside risk. So what do we want to do? We want to hedge that downside risk off. And we have a working order in right now to sell the 26-10-20 call spread and the 25-50-40 put spread we're going to buy to clean up our downside risk. And we literally flipped from a bullish stance to a neutral to bearish stance. On this graph, you can see that if the market falls is where we make more money than if the market sits right here. It has a bigger range of profitability. And the reason why we're flipping from long deltas to short deltas is right before we get that 2600 in the SPX, an area that will probably be a little bit of resistance, will be filled on this second trade. And if we do pull back because it's resistance, we're going to want short deltas. Once we're filled with that, I plan on augmenting it a little bit more and getting some long deltas on. And this may be one of the ways we're going to do it. By what you'll notice is when we create this third leg of buying a call spread and selling a put spread, what do we have on? Well, when we sell a put spread, you would think we have downside risk. Anytime you sell a put spread, you're going to have downside risk. But by carefully placing the strikes in the right place, you see that we still have downside profit potential, and we are now getting upside profit potential. The strikes are being carefully chosen based on where our existing position is. It's really trying to intellectually take your existing positions and use them as a substitute hedge. Now, it gets a little bit complicated in terms of how you go about it, but I'll tell you what, every single time this year in pot class, I was adding new positions to get long deltas. I was always cognizant of the fact of where my risk was. Wherever my risk was, I would adjust accordingly. And then sometimes I deviated from the normal way of getting long deltas. And instead of doing a risk reversal, sometimes I just did call spreads or sold put spreads. And people are like, why are you deviating from what you've been doing before? Well, it's because at that time, my current position didn't have any embedded area of profitability to the downside. And so I couldn't leverage that. And I just went out and said, instead of selling a put spread that would add risk to the downside, we'll just do the call spread and hedge it off real quick. So I'm saying that even though some of you guys are in pot and watching all these examples, behind the scenes, what you're not seeing is the mighty Oz. When you pull the screen back and it's just a little old me, carefully making sure that there's not a better way to do things because I've got all these other positions on that could actually help what I'm doing now. We have a couple remedial classes in the pot class on trade augmentation. In order to keep time very limited here so I don't eat up your whole weekend, if you have any questions more about trade augmentation, contact the office and Glenda will be happy to send you a link to the trade augmentation pot class to give you a little bit more indication of what we're talking about. The second thing we're going to be talking about is spiked collars. And I don't want anybody to misconstrue that this is the same old generic collars book I wrote 15 years ago. Whatever it was, 13 years ago. The first book I wrote on collars was called Stock Options and Collars. And it was a huge hit because a lot of people were doing collar positions and they were collaring the stock and not making money, and they couldn't figure out why. What they didn't understand is that the risk graph of a collar is the same risk graph as a vertical spread. And anytime you buy a call spread, anyone who's ever bought a call spread knows you can lose money on a call spread. If the stock doesn't do what you want it to do, you can lose money on a call spread. And so in order to avoid some of the shortcomings of a call spread, we have to do something a little bit different. Now, that original book was just meant as an introductory book. It was designed to teach people how the standard garden variety collar works. But it didn't go into a lot of detail about variances of the collars. It was called collar, stock, options, and collars. Why? Because it was very remedial. Now, from there, I could have gone a lot more in detail into how I teach some of my students that I mentor. And I have obviously, in all modesty, been blessed with the fact that a lot of people seek me out for mentoring. But there's only so much mentoring I can do. I can teach a couple people one on one, or I can teach a lot of people in a pot type format or a textbook format. But some people I've just become really close friends with, like Peter Ox, Peter Zamaya, Robert Chastain, all became really close friends of mine. And so I spent a lot more time with them than I do with most people. And I taught Peter Ox the collar because he just is a nice guy. Anybody know Peter Ox? Just a really, really nice guy. And he and I live not too far from each other. He's really into motorcycles, and I like to ride. He's a pilot, and I like to fly. We both hate his wife. Everybody, we had so much in agreement that we just hit it off. And so he was a strange guy in the fact that he's got into this business from being a robotics engineer. He designed the robotics for the BMW plant in Stuttgart because he speaks in German. And eventually BMW didn't want to pay him his exorbitant fees and then just bought the company instead. And he got this giant windfall. He paid off his house and then put $1 million in the stock market. Well, in a bull market, in a very strong bull market, he was buying stock. He's long the market and still losing money, to the point where he took his $1 million and got it down to about, I can't remember the exact numbers, but about 38,000. Then his wife started getting a little frustrated with him. And he sought me out and asked for help on learning this stuff. And we became friends, and I sort of, oversaw his positions and gave him little hints here and there. That's what the spiked collars is. And let me explain in a little bit more detail what the spiked collars really entails. What you see right here is the average return of the stock market in the last 30 years since the 87 crash. And you see that in the last 30 years, remember, keep in the back of your mind though, when I show you this number, that we're also in the biggest bull market in the history of mankind. We're setting new records every single day in terms of bull markets. So these numbers are a little skewed, but the stock market's been averaging in the last 30 years in a positive return of 11.6%, which is an over exaggeration because it's based on the indexes, and the indexes are a little bit rigged. When the stocks really stink, they take them out of the index and put the really strong new bullish stocks in. It's also been a bull market, etc. There's a lot of reasons why this number is a little bit inflated. On average, it should be under 8%. Anyhow, 8% is still going to give you a decent, and when I say 8%, I'm being optimistic. But anyhow, 8% is a decent return for long-term holdings. If you're a 25-year-old kid and you're getting into the workforce and you open up a retirement account and every single month you put a little bit of money in and you get 8% a year compounded until you're 65 and a half, you're going to do very, very well. But it's not any kind of money that anybody can live off of. If you're going to be living off of this, you need to get much higher returns. Also, if you just buy the stock and hold on to it, there's a lot of volatility along the way too. It is very hard to stay long stock. If you look at that first red box from 2000 to 2002, what was that? That was the NASDAQ bubble blowing up. And anyone watching the stock markets right now would probably think we're probably due for another NASDAQ bubble, housing crisis bubble type explosion to the downside again. The returns this market has done since the elections was crazy. Anyhow, from 2000 to 2002, you see the market's down. I don't know what that adds up to, 44, 45%. When you see your account get cut in half in 3 years, how long are you going to hold on to it? How long is your family members going to like ridicule you for still being in the market? They'll say you're nuts. And they'll tell you, I'm not in the market. I didn't lose 40% the last 2 years. It's very hard to stay in this market without protection. So people get into the collars. And for those who are watching that don't really know what a basic collar is, I'm going to give you a quick 3-minute explanation of what a basic collar is. Anytime you go out and buy stock, you're hoping for that market to increase in value. But it doesn't always do that. As a matter of fact, I can make any stock go lower. All I have to do is go out and purchase it. It's crazy. You're just hoping that it grows. You're hoping the stock grows just like a tree. Well, sometimes the tree gets root rot. And you want to hedge that red area where you could potentially lose money. Well, the first thing you're taught is to buy a put. The problem with the put is it costs a lot of money. It works the same way as homeowners insurance, car insurance, etc., except for because there's a 50-50 chance of your stock burning down, the cost of your put is going to be crazy expensive compared to homeowners insurance. You have a very small chance of your house burning down, unless you're in Northern California. But you have a tremendously high chance of your stock burning down. So people love the put because they get protection. They can sleep at night until they realize the stock has to have outrageous returns over the course of a year in order to pay for it. If your put is going to cost you, say, 35, 40% of the value of stock by buying a new put every month, your stock has to go up 35, 40% over the course of a year just to break even. Now, it does wipe out, as you can see by that white arrow, the risk to the downside is the stock goes down and you lose money on the stock. Your put kicks in and offsets it. But really, what this is a long stock, long put position is the same thing as a long call position. And anyone who's bought a long naked call knows you could lose a lot of money on it because of time decay. So one of the ways to offset that risk is when you have this position on, to sell a call against it. Okay, but just let the slides transition a minute. And when you sell a call to offset the cost of your put, you see you have essentially a long call spread position. But what if the stock drops? Well, you know you're protected. The most you can lose on a long call spread is what you paid for the call spread. Okay, but you're still gonna have a loss. Yes, the stock may go to zero, but the put gains will offset it. What we've been doing in the pod class is once we go and sell off and the put or put spread or put butterfly goes in the money, we sell the put out. Excuse me. We take in the money from the put sale and we use that to buy more shares. So once the stock goes lower, we're buying more shares cheaper. This is not dollar cost averaging like Susie Orman tells people to do. Okay. As a matter of fact, in the pod class last Wednesday, I talked about dollar cost averaging and people were asking about it. And I dug up an old study I did on Valiant because we had been trading Valiant earlier in collars. And you see the Valiant was as high as 262. Does Peter get his hatred of Susie Orman from me? I don't remember what came first, the chicken or the egg. Um, but it really doesn't matter. I don't even know if she's still on TV or the radio anymore, because anyone that dollar cost Valiant is probably sending her hate mail right now. For example, here's Valiant. What if we bought Valiant and every time the stock fell, we buy more shares? That's, dollar cost averaging. And we did a study on it. Let's say you started out, bought the stock at 260, and every time it fell in a certain increment, we'd buy more shares. So it fell from 260 to 250. Well, 250 is a nice round number. Maybe there's support there. We'll buy 100 shares. And then every $25 down, we're going to buy another 100 shares. We didn't get into Valiant in our pod classes until it was in the 25 area. But had we bought stock at 260 and rode it all the way down to when it was at the 25 area, we would have an unrealized loss of 139,000 because our average price is 149. If you buy a stock at 250, 225, 200, 175, 150, 125, etc., you're lowering your average price, but when the stock's at 25 and you need it to get back to almost 150 to break even, you're probably not going to ever see your money. Okay? Very few stocks act like Apple, where it fell from 60, went down to 15, Steve Jobs comes back, and it goes back to 150. There's a much brighter, better idea, a much better way of looking at this. Most people just own the stock, don't even hedge. They don't want to even spend a week or two reading a book about collars to ensure their financial success and freedom. Most people spend more time planning a Christmas party. Think about this. Most people spend more time planning a Christmas party than their finances. And then they wonder why 71% of the people in this country are living paycheck to paycheck. 74% of the people can't write a check for $500 if there's an emergency. And 85% of the population doesn't have enough money to retire on to maintain the lifestyle that they're living right now, because they don't want to read a book. It's just too much effort. And so when most people lose money, they say, well, it's not about the money, and they rationalize it away. But guess what? It is about the money. Okay, because there is no freedom like economic freedom. We're not dollar cost averaging. Instead, what we're having is when the market falls, we're going to lose a little bit, but then we will, as soon as we're at our area where we're going to lose a little bit, we hope the stock keeps falling because we can't lose anymore, and we're going to take the money from the puts and move everything down. And now this position is acting like we had bought it much cheaper. Like we bought it at 51 instead of 55. Okay, so what happened is we're losing money of stock in our left pocket, but a profit from the put is going in the right pocket. And it's almost netting out. But what we're doing different with the spike collars than we're doing from the regular collars, and what we're going to be teaching in Maui, is how to use different hedges. Most people are just buying a put and selling a call. And under most circumstances, that's overkill. You're limiting your upside and overprotected to the downside. You don't need that much protection to the downside. And most bull markets, returns happen over the course, the whole year's returns happen over the course of 4, 5, 6 days. And so you don't want to limit your upside either. So we're going to use put spreads and call spreads and butterflies and 132s, depending on the stock. And we're looking at different time frames. And here's why. This is United Airlines. It closed at 59 and change on Friday. And this is the chart for an entire year. It got as high as 83. It started the year at 55.75. Let's say you bought it a year ago today at 55.75. You saw it go up to 83. You're bragging to everybody. You're the world's greatest stock picker. Think about that. 55 to 83. It's $28. You're up 50% in months on your money. Nobody does that. The market in a good year, in a bull market, is up 11% in a year. You're up 50% in a couple months. You're a genius. You should be on CNBC. All of a sudden, United starts they've got their business class, their economy class, and then they decide to open up their fight club class. And they start beating up passengers and the stock falls. Well, now, over the course of a year, the stock is down to 59 and change. You're up only a couple dollars over the course of a year. But what's happened? You could have gotten out at 83. You didn't. Because you thought, well, I'm up 50%. It's going to 100. I'll get out at 100. And you got greedy and you missed it. Nobody can time a market. Warren Buffett was just saying this last week. Nobody knows when. He thinks that the crash is coming too, just like I do. But he said, I can't predict when it's going to happen. Charlie Munger can't predict where it's going to happen. That's his assistant. The best pickers in the world don't know when the crash is coming. I agree with them. So what do? We're adjusting according to what the market's giving. What we're going to be doing that's different from what was in the regular collar account or book is we're going to look at what volatility really is. What's volatility? Well, over the course of a year, you see the stock has moved pretty much. It's a pretty decent move. If you look and break it down by month, or just one section of meaningless noise that most long-term investors wouldn't even notice. They'd be like looking at their account and seeing not much is going on. That whole little area from, well, let me draw it for you. But from right here to right here, it looks like it's just in a channel. Then we broke through the channel to the downside, and that channel became resistance. Then it went through the resistance area, and now the top of the channel became support. And then the bottom of the top of the channel became resistance again. And then once we went through the whole channel, we really started falling. Everyone see that? Okay. And what people are looking at is this over the course of long periods of time. But inside this long period of time, there's a lot of kinetic energy going on. All that energy can be converted into capital. Most long-term investors aren't looking at this stock other than once a year. They're saying, well, I bought it here, the stock went up, then it fell, got down to where I bought it at, bounced again, and at the end of the year, they're bragging to their friends they're up 8% this year, which is kind of pathetic considering the market's up 25% this year, 26%. But they're up. What they fail to realize is all this movement can be translated into dollars. Market makers are trading daily Why? Because every day has its own little layer of volatility. And they're going to try to capture 80% of the range of this move, and 80% of the range of this move, and 80% of this move. And every single day, they would love to capture 80% of the movement. Let me blow this up. This little box, let's just blow it up and take a closer look. Here's that 1 month. Beginning of the month and the end of the month, we're almost in the same spot. Not exactly, but within like 50 cents. And the question comes in, does this work with ETFs? Absolutely. As a matter of fact, I like it in ETFs and stuff better. But that's a personal choice. Some people like the strange moving stocks. They like the earnings. They don't mind dealing with options that are going through X dividend and then in the money and trying to have it to figure out if it's going to be an early exercise or not, because they think they've got a good feel for it. As a matter of fact, in the pot class this year, we traded 3 different stocks. We were in eBay, we were in Las Vegas Sands, and we just exited Netflix that we've had for a couple months on Friday. I'm going to start a new name on Monday or Tuesday. Um, I'm actually considering just doing a collar in pot class starting on Monday using ETFs, and then getting a little bit fancier so I can show other things to people. But yeah, it works all the same way. As a matter of fact, it's even cleaner. Now, some people don't like doing them in the indexes because you have mutated volatility. Remember what the Standard & Poor's 500 index average means, or the Dow Jones Industrial Average means. It means an average. Okay, it's like grading on a curve almost, where it mutates the volatility. What is great for stock traders is movement. You don't want to buy a stock at 100 and it just goes to 99, 100, 101, back down to 100, down to 99, back up. There's not a lot of range there. 1% range over the course of a year is a killer. The bigger the range is, the better the chance of, or the more opportunity to capture all this noise. The bigger these lines are, the more spread apart they are, the more volatility there is. And what we're trying to capture is that volatility. So some people like Peter, think they can pick the next winner. I'm not under that assumption. Peter may have a better feel for stocks than I do. The other reason why Peter may not like the Qs or something like that is because of this mutated volatility. The more movement there is, the more we can capture. Remember, we're trying to capture about 80% of this movement. So would you rather capture 80% of something that's in this range of pink lines, or 80% of the wide range, I should say, which is the pink lines, or if it was a less volatile name, means less movement, 80% may be the bandwidth of the blue lines. I'd rather have 80% of a wider range than a tighter range in individual stocks, because they have 2 kinds of risk: the risk of the market as a whole, which is systematic risk, and then risk of that specific name. The CEO may quit, there may be um, markdowns, bad accounting, all kinds of little things that could disrupt the stock itself. Stocks will have a second type of risk as well, non-systematic risk, meaning company-specific risk. So, but then again, I have a friend who is a professor at Northwestern um, University, and he manages money as well, and he manages it using the SPYs and SPX. So it really depends on what you're trying to achieve. If you're really bad at picking stock names and you want a little less volatility in your life, like my friend who's a professor, the SPX or the Qs or something are ideal. Why? Because he's teaching class half the day. He can't afford to have news come out in the stock and not adjust. So it's really up to the individual. Anyhow, what's great about what we're going to be doing with the spike collar is this. Let's take a look. This is 1 month. Look how much range there is in a month. When we put the trade on, boom, a few days later, the stock fell from 75 and change to 69 and a half. That's a pretty big range, guys. That's almost $6. It's what, 8% range in a couple days. Then a couple weeks or a week later, guess what happens? We get another big range where instead of adjusting every month or once a year, I'm now adjusting every week or two. And now what I can do is instead of having to wait to the end of the month to adjust, what I'm going to try to accomplish here, and it doesn't always happen, but that's my goal, is try to get 80% of this, 80% of this move, and then participate on the way back up. Whereas if I was only looking at things on a month-to-month basis, it really didn't move much over the course of a month. So the dynamic hedging that we're going to be doing with spiked collars means what? What happens when the market falls? Let's say you have a stock and the market falls. What are you going to do? Well, as the market falls through, maybe your put strike is right here and the market falls through. We're going to sell our put out, re-hedge, buy a new put. But we took in a whole bunch of money. And what can I do there? I'll just go out and buy maybe another 100 shares of stock. Now, on the way up, I'm participating, whereas I wouldn't have if I was only hedging monthly. So every time you see a big drop, I'm buying more shares. In this example right here, this one little 1 month area, I had an opportunity to buy stock, more shares, using the money from the puts, not putting more money into it out of my own pocket, not doing the Susie Orman, a dollar cost averaging, and going to the bank, and the teller saying, "Oh, you're taking a 20,000 out. I see you're feeding your stock again this week." We're not going to be feeding this thing any. This is a biosphere. It's got to be self-sustaining. Okay, we're not investing in a lion that's going to cost you $100 a day in stakes. Anytime we're buying more shares, it's because of the whole biosphere working in conjunction with each other. You've got plants producing carbon dioxide. The fish in the water uses the oxygen, emits carbon dioxide, which then the plant eats. Go back to the previous slide, and we're going to see how the smaller time frames make sense. If I'm only hedging month to month, at the beginning of the month, the stock is at about 75 and a quarter. At the end of the month, it's at 75 and a half. I only made $0.25 on the stock for a month. But if we go back and look at a year, you'll see that actually this little area we're studying doesn't look like much compared to the year as a whole. And by adjusting dynamically and using other things than a normal put or put spread, we can dramatically increase our returns. And that's how the spike collar is completely different than a regular old your mom and dad's collar where, oh, they own stock, might as well buy a put to hedge, but the put costs so much, I'll sell a call and see where things are at expiration. Okay, this alone, this we have 3 topics we're teaching in Maui. This alone is reason enough for a big chunk of our people coming to Maui and say this alone makes it worthwhile for the trip and the materials. Because I've got up stock for the next 10 years before I retire. Think about how much money I can make by hedging this thing correctly. Even they may not have any interest in the trade augmentation or water. This alone is enough for them to go. And to answer the question, so the difference, you got questions coming in. One is, so the difference you adjust quicker, that's part of it. There's a strategic area that you're going to adjust, not just because it moved. But that requires a lot of explanation. And we're not going to buy a put. We're going to use different tools. And it gets a little bit confusing that I can't really explain in this period of time because guess what? A lot of times we're going to start with a put spread. And as the market falls, we'll sell a put spread against it and turn the trade into a condor for even money. Now our downside hedge costs nothing because we bought a put spread for $1. As we fell, we sold a way further out of the money put spread for $1. So now we're in this condor. But we sold a call or a call spread for $1 to offset the cost of our put spread. So now our hedge is on for $1 credit. And we're manipulating the hedges. We're manipulating the call side as the market's going up. We're manipulating the put side as it goes down. And we're going to be trading more actively. So it's a combination of all those. And I wish I could give you a lot more detail, but it would take 3 hours to give you a detail on this. I just don't want to eat up your whole weekend. This is just to give people an understanding of what we're teaching. It's a beautiful thing. People who know Peter from the other firm that he used to be working for know him basically as collar man because he took that 38,000 he had left after losing almost $1 million. And after I started teaching him what I'm going to be teaching in Maui, he took that account and within, I don't remember 3 years, the account went from 38,000 to 1.3 million. That's how fast it grew. And, you know, I don't know. I don't know what else to say other than that. Think about that. Go from 38,000 to 1.3 million hedging. And I'm not making this up. A lot of people listening in know Peter Ox. They've seen his spreadsheets. He used to keep this big, long, 1,000-page, slight exaggeration, spreadsheet with them that showed every single trade he's ever done. He journaled everything like Thomas Edison with the little notebooks. And it showed every single adjustment he ever made over those 3.5 years. It can be verified with accounting statements and stuff. And he didn't get lucky. Half of the stocks out there, he could have accomplished something relatively close to that. It's not like he bought a stock and it got taken over and went crazy and stuff like that. It was a little stupid. He started with Bed Bath and Beyond, then moved to AutoZone, then etc. Household names. So it's really all those different things, different positions, adjusting the positions instead of closing them out, and more adjustments that create the spike collar. Now, water. I know there are a lot of people here who also saw me teach liquid. Um, and liquid is unbelievable. It is a way of maneuvering around winners and losers. Water is the same thing, but on steroids. And the reason I didn't ever want to have to write liquid or water ever again because it's a very difficult subject to write about. There's a million permutations. And you go off on this binomial lattice, it just keeps getting wider and wider, and it's very hard to write about. But since I wrote the last book, I had so many questions about it. And there was also a lot of people say, well, can I do this? And I'm like, yeah, obviously. Well, why isn't it in the book? And I'm like, well, you know what? I just took it for granted because I do it all the time. And it didn't even occur to me. And since I wrote that first book, every time these questions come in, that I realized, oh man, this is where I could have improved the material. I take those questions, file them, and eventually all that stuff is coming into the new book. Now, what is water for those who don't know? There are two things that can confuse and will frustrate traders, every single trader. What are they? Does anyone know? Let's say you buy a call spread. What's going to happen? One of two things is going to immediately happen to you. Think about it for just 1 second. First, what if you buy a call spread and you're up a little money and you don't want to give it back? This is where most traders screw up. Beginners to intermediates have a real hard time. When they go out and buy a call spread for, say, $1.50 and it goes to $2, they start thinking, you know what? This market is looking a little weak. I may get my profits back. Oh, man, I better just sell this thing out. That way I've got a profit for sure, and I can't risk my initial investment either. And they're thinking to themselves, I don't care, it's only 50 cents. On 10 contracts, it's $500, and they rationalize their decisions and everything. It's not a good thing to do. Okay. The rule, which is counterintuitive to how people actually trade when they're starting, is to get out of your losers real quick and let your winners ride. The average person does the opposite. Let's say they go out, they buy that same call spread for $1.50, and now it goes down to 85 cents. They're thinking to themselves, wow, I'm down 65 cents, almost half of this investment. What do I do here? Well, I can't get out at 65 cents or 85 cents because I'll lose half of my investment and I won't have on anything that can make me my money back. And so what they're doing is, and they do this especially with stocks. They'll buy a stock and they'll do the Susie Orman. The stock will go, they'll buy a stock at 100, it goes to 90. And they won't say they're wrong. They just got in early. Had they waited a week, they could have gotten it $10 cheaper. And they'll say, I can't get out now because I'll lock in a $10 loss and I won't have anything on that I can make that $10 back. Instead, what they'll do sometimes is just put an order in to sell the stock at 100 when it eventually gets up there, if it eventually gets up there. And so what are they doing? They're letting their losers ride. We saw Valiant. If you bought it at 250 and you're trying to wait to sell it at 260 or 250 just to break even, well, it went to 25. How long are you going to wait? And maybe they're doing the Susie Orman. They bought it at 260. Now it's 150, and they'll buy a little bit more. If it was a good deal at 260, it's got to be a screaming buy at 150. At 100, you sell your car and buy more shares. They're letting these, not only are they letting these losers run, but they're actually adding to a loser. And I can't remember who said it. Maybe it was Robert Prechter, that only losers add to losers. But so typically that's what happens. So we go out and buy a call spread for $1.50. It goes to 2, and now we're facing this conundrum. Well, I'm right. How cool is that? I'm finally right. Most of the time I buy a call spread, the market falls and I'm losing money instantly. This time I'm right. But I don't want to get the money back. Now I've got $2,000 at risk on 10 contracts instead of $1,500. What do I do? What do I do? And every time the market ticks down a little bit, they get nervous. Water teaches us how to take our money off the table. And yet, adjust and leave some residual position on that can make more, just like if we had kept the long call spread on. And I haven't done a lot of water trades yet. I'm going to start focusing on it in the pot class towards the end of the, for the rest of the year, because we were focusing on other examples, advanced risk reversals and vipers and stuff. But I'm going to start playing with water a lot before Maui so people get a feel for it. And what if they get the trade on and they lose money instantly? That's even more painful. And what I've seen a lot of people do, so don't make, I'm not making fun of anyone on here if they've done this too, because I've done it myself. The losses are so painful emotionally that we'll rationalize any way around taking that loss. So they'll have an order in, they'll buy a stock or a call spread, call it $1.50. And then all of a sudden the market goes the wrong way and that call spread goes to 85 cents. And that may have been their stop order. They said, well, if I lose half, I'll get out at 85 or 75 cents. Now you're looking at 75 cents. Right in the face. And all of a sudden you're saying, well, if I get out here, I'm going to lose half of this trade. And the rationalization process comes in. It's like, but you know what? It looks like the market's at a bottom and may bounce from here. This thing may bounce and I may get this all back. So they'll say, you know what? Officially my stop loss is activated, but I'm going to give it another 15, 20 cents. So I can stay in it just a little bit longer. Then we get down to that stop. You're like, well, there's only things. I might as well give it another dime. Because it's at 65 cents, but the bid ask is at 50 cents. There's only 50 cents left. There's not a lot to lose. Might as well keep it on and see if I can make it back. Besides, the stock looks like it's about to go up. And the next thing you know, they had a stop order to lose half, but they lost all of it. What we do in pot is a lot of water type trades. Indirectly, but not really. It's more of hedging things off. I'm going to start getting into the more creative trades that'll freak people out at first. The first time I taught these type of things, people really pushed back. They said, wait, you're creating something that's bullish into something that is bullish or bearish, but if the market stays right here, I could lose some money. And it freaked them out until I proved to them that they couldn't. Or what they could lose is so minuscule, it's not worth worrying about. And so it's really it was probably the funnest class I ever taught, because it was the class where I had the most people in the room with the light bulb visibly lighting up above their heads, where I showed getting out of this trade will cost you more money than spreading it off. It's very, very powerful. I use this analogy in closing. I use this analogy. You can become a really good trader without knowing water. Okay. There's some really good traders down there that are very disciplined with their stop orders. And they will go out and buy something. As soon as it goes against them, they get out. And if it goes their way, they let it ride. And so they have big winners and small losers. But even they mess up because most of the time there was something else they could have done instead of exiting that was better. They could have traded something, turned that position into something else that would have taken all the risk and money that they're worried about off the table, but left opportunity on to make even more. Those guys are the superheroes that you hear about. The guys that have one extra trick. They're thinking the world is playing checkers and these guys are playing chess. They're thinking a couple moves ahead. I have seen guys looking at some ugly trades, and instead of just closing it down, spreading it off in a way where they took almost all the risk off, just like if they'd closed it out, but left an opportunity on, and that opportunity made them all their money back. So instead of a loss in that loss column, it was a break even or winner. That little variance once in a while, even a couple times a year, is huge. In Pack Class, we have a couple $3,500 losses on the sheets. Imagine if I had the time to liquid like move through the markets. Way that water flows around and over and under to get to a common bottom. And I take those 5 or 6 or 7 $3,500 losses off the table into break evens or winners. We'll call it an average of a $5,000 change on 7 contracts. That's 35 grand in a year. That's how powerful water is. Okay, and some people are, if you're a fan of Chicago sports, which is a very difficult thing to do, it means you're not only a masochist with extremely, extremely high levels of pain tolerance, but you're also got to be a fan of Walter Payton. Now, I love Walter Payton because I've got so many experiences with the guy before he died. They play at Soldiers Field. When I was in grade school, Soldiers Field was being redone, so they couldn't use the stadium for a year. They used Northwestern University's field, which was then Dyke Stadium, to play and practice on, which was a block away from my grade school. And being the good little boy, listening to the nuns and priests and doing what they say, I snuck out anyways. And I jumped over the fence into the bushes with a buddy of mine every day at lunchtime. And we snuck into Dyke Stadium by climbing over a 15-foot gated fence to watch the Bears play and practice. And every day I'd walk over there with a football until I got everybody's signature eventually. And I became a real big fan of Walter Payton. Then when I got to college, turns out my roommate lived right a couple doors away from Walter Payton in this little area that shared the common pond. And I'd met him again. And we're out there like sailing in this little pond with this little sunfish, and all of a sudden the wind died and had to jump out of it and pull it to shore and then drag it around the shore over Walter Payton's property. And he's out there by himself having lemonade and Would you guys like some lemonade? With this high pitched voice, and we just sat down and BS'd and stuff, and it was pretty cool. But if you're love and are a fan of Walter Payton, he ran like water. He looked for the biggest opening, but when a rock was around, he went around the rock. Okay, he just he ran like water flows down a stream. Exactly the same way. Some of these guys like try to outrun these guys. Some guys plow through people. He would just brush around them like water brushes around a rock on a river. And so that's like immediately when I saw Walter Payton run, he reminded me of water on a stream. Well, John, if you're a Vikings fan, you pretty much hate Walter because he set records against your team all the time. Um, was like this 275-yard game against you guys. Painful memories if you're a Vikings fan. Anyhow, Walter ran like water, okay, around defenders. We're going to move our positions around losses in the same fashion. That's what water is. You know, here's a little thing I'm about to do as a water trade. We have a position on in Tesla. Once again, I'll go back to Tesla. Here's something I might be doing on Monday. We're into a 132 trade in Tesla. After earnings came out, the stock fell down below 300, and we got long a wide call spread and then sold some baby call spreads against it to this is what we have on. Now, off to the left, you can see we have on $1,800 of risk. We started with, I think, $3,600 of risk. But we can make $8,000 in profit. How can I get that risk from $1,800 down to zero and get my profit higher? Again, I've got this trade on. We're up a little bit of money on the trade. The first instinct people say is, Scott, you're up $1,000 on this trade. Why don't we take the profit and run? Because if this stock backs off and there's everybody selling and there's nothing but bad news in Tesla, and I really think it's going below 300 again because the government subsidies for tax credits on Tesla are going away. No one's going to buy a Tesla without the tax credits, and they're just fired more people, and I'm getting all these lists of negatives. People have the trade on and they're immediately emailing me saying, we got $1,000 on this thing in a day. Why not take the profit and run? I'm sorry, that's not good enough for me. I'm risking huge money to make 1,000. I've got my risk reward ratio messed up. I understand how you're concerned that we have on $1,800 of risk. But there's something else we can do. What I'm going to do on Monday is probably based on the closing prices. If we open unchanged on Monday, is end up with a position looks like this. If we open up higher, it'll be even better. But here, our risk went from 1,800 down to zero, and our max profit went from 8,000 to 10,000. Comparing the two, look at this. The stock is at like 306 or something. So we're right near our break even to the downside. At expiration, if the stock is right here, we're going to break even. If it goes down to 302 and a half, we lose everything. The green arrows show that after the hedge on the bottom, we can make almost 10 grand, whereas right now we can only make 8. The red arrow shows that plateau that I can make on the trade beforehand of a little over 3,000 is higher. It's now 5,000. Then the orange arrows show where you see on the top before the hedge how we make a peak at around 312 and a half, and anything above, say, 315 or so, it plateaus out to be a $3,000 winner. That orange arrow in the bottom graph shows where we have a $3,000 winner, which is just under 320. So we have in a $20 range to the upside from where we put the trade on. The water adjustment outperforms the current trade. $20 to the downside, the water really outperforms because we break even instead of lose 1,800. This is an introduction to water. Like I said, for the rest of the year until Maui, I'm going to start doing some playing around with water trades to give people a better understanding of what they got to expect. Now, with the water, there's a spreadsheet. It's a complicated thing, but it's not really too complicated once you understand it. There's a systematic approach to looking for ways of spreading this off. And it's a flow chart almost. So you go through the flow chart and just start checking things off. And anybody can do it. And remember what Bruce Lee said. This is a game changer, people. It is the difference between really good traders on the trading floor and the guys that are superstars. And that's what water is. Okay, now as far as the details, the function room is at the same place we had last year. Anybody that was there last year realized that the staff there was unbelievable. I've never been at a seminar where things were as smooth as possible. We had the banquets manager in the room every 5 minutes, 10 minutes, 15 minutes, checking to make sure everything was fine. Anything we wanted, they gave us. One of the days of the class, we had a little party with mimosas and cake and everything. They were just bringing out plates and everything. They didn't bother anyone. They weren't trying to hit anybody up for extra money or anything else. It's going to be at the Sheraton Maui Resort, 17th, 18th, and 19th. Now, those who aren't going but want to watch Maui anyways, they can't make it out to Maui. It's too much of a time commitment. They don't want to spend the money on the travel. We're broadcasting it. And it's not being broadcast like you're getting your broadcast now where you're just watching the slides. The same film crew we had last year will be out there again this year. Okay. Brandon, some of you guys met, is an unbelievable professional videograph artist. We'll have 3 cameras out there filming the screens, me, and whatever else the third camera's panning to. It's like being in the classroom. Then when the class is done, Brandon edits it. So much so that he's working on it almost every day for months. I think the last one took 3 or 4 months for him to get done editing it. To where all the little inappropriate jokes I made were, all the sneezing, the coughing, whatever, whichever camera angle was the best, he would insert that one in there. The guy's good. He does the Jaguar commercials. So it's not like just watching slides on a screen all day long. You're actually participating in the classroom through your computer. You're seeing everything that's going on. So totally different experience than before. So you're not losing anything by watching it at home. Lastly, guys, this is how Glenda is setting things up. Everybody knows that we have our one sale every year, which is our Cyber Monday sale. That's coming up in a couple weeks after Thanksgiving Day, the Monday after Thanksgiving. And we reduce a couple things down in price. We're not big discounters, and we're not big have a sale every 2 day people like some of these firms are. We trust our material, and we trust our students to not fall for those gimmicks. Um, but what Glenda is doing is we have an early bird special that already expired, where there was, I think, a $300 discount by signing up by a certain date. On Cyber Monday, for just Cyber Monday, it'll be the last time people can get the early registration price. I let Glenda come up with the pricing and run the business under the business. She just double checks with me on some things, but she has a lot of autonomy because I've got to focus on the product. She said on Cyber Monday it's going down to the pre-registration period or price of $29.95 from I think $32.95 right now, so about 10% discount. Anybody wants that who's listening to this video, it wants to sign up today ahead of the Cyber Monday sale, just contact the office and Glenda will call you. And we'll honor that because that's going to be the Cyber Monday sale price for this. There'll be a couple little discounts, but we're going to give a lot of people a chance to get in at the early registration price because, especially Italy, we've got a whole bunch of new people that weren't even here to get the early registration. They didn't hear about it. We don't want to penalize them. But then after that, it's going right back to its normal price. If you guys have any other questions whatsoever about Maui, let us know. I will also send you guys, a lot of people saying, send pictures, send pictures. I will take some pictures of what I've taken just myself. I'm not a professional photographer. Most of the time, I'm taking pictures off of my iPhone or my scuba camera that's made for underwater pictures. So it's not like some of these guys with their $10,000 Nikons. I don't have that kind of equipment. But I'll send you the pictures I have. It's beautiful. It is paradise. That's why we have it there every year. That's why we have students showing up every year. They probably don't even want to hear me talk, but they figure if they go to a seminar on trading in Maui, their trip to Maui is a write-off. Anybody who's not signed up and wants to take advantage of the early discount, just email the office at admin@StratagemTrade.com. Glenda will help you get set up right away. Any other questions, send an email there. I will send out the pictures. Also, last thing I want to say is last year, we sent out a video on stuff to do when you're in Maui, places to get cheaper hotels and stuff. That is still available somewhere. I'll see if Glenda can send it to you. You don't have to look at it if you're not interested. But we're going to be sending out a survey for those people who are going to Maui again. Remember, every year we're in Maui, I treat you guys to an event for group bonding. The last 2 years has been a dinner cruise where we were whale watching while having mahi-mahi or prime rib. All the cocktails, everything I pick up. We're going to send out a survey real quickly. I don't know if it'll be this weekend or a couple days after it about what you want to do. Do you guys want to go to Mount Haleakala? Do you want me to rent a party bus and everybody go take the road to Hana, which is like the most beautiful road there is in the country? That's why they filmed Jurassic Park there. We went on a whale watching catamaran ride, I think the year before that, where the whales We got right up to the whales where literally the whales were going under the net of the catamaran and brushing against everybody's fingers. There's so much stuff to do there. I'm going to pick up again the cost of it, but I want to get a vote on what you guys want to do. Okay, we're going to give you all the choices out there. There's luau's we can have. Um, there's a million different things. You guys vote on what you want, and we'll do it. Other than that, I wanted to keep it nice and short. I went a little bit longer than I anticipated, but it gives you guys an understanding of what Maui 18 is all about. We're happy to answer any other questions, and we're looking forward to seeing you there. Have a great night, guys, and rest of the weekend. Take care. Thank you.